It's only a matter of time before the next big crash. Now, I don't know when it is, and nobody else does either. What I do know is that it feels like it's coming soon. One of my favorite quotes is, "Everyone has a plan until they get hit in the mouth." For those of you who have not yet gone through a real market crash, I'd say it feels more like a gut punch than anything else. It doesn't just hurt in the moment, the impact lingers for days and weeks after the fact. My name is Zuhair, and I made this channel to make investing simplified. Remember that all investing carries risk, so please do your own research. This is not financial advice, and I am not a financial advisor. Early last year, in 2025, many people started to get worried because we had a new president start his term with some polarized views. We knew we'd be in for an interesting year, but we didn't know exactly how interesting. We found out quickly when tariffs were announced in February, doubled down on in March, and intensified in April. We can literally see what this did to emotional investors and institutions by looking at the S&P 500 chart from last year. February started the skid and it accelerated through April. The problem was that many people started selling just because of the what ifs, thinking these tariffs were the end of the world, that global trade would shut down, or that margins would vanish. There was a genuine fear that the US market was going to drop significantly. The sentiment in the finance world was that this time was totally different, and that we might not even have a functioning stock market by 2026. People started panic selling. As more news came out about global tariff retaliation, it made investors even more nervous, leading to more selling. When people saw massive sell-offs and declines of 10% to 15%, that fear compounded. Investors were selling simply because others were selling. Unfortunately, many people lost money, not just by selling at a loss, but by missing out on the recovery. If you look at the rest of the year, the market accelerated right back up. Anyone who sold in April and waited for a deeper dip lost out on 25% or more of the gains from the bottom. Had they just done nothing all year, they would have gained around 18% simply by staying put. Let's look at actual historical figures from long-term research regarding market corrections. After 10% corrections, the average 3-month return is plus 2.8%, and the 6-month return is plus 5.4%. After 1 to 2 years, the average return jumps to plus 114% based on data going back to 1928. After deep declines, 15% plus, the average 12-month return post-decline is historically about 47%. While these figures don't guarantee future returns, the history is clear. Corrections of 10-20% are common and usually recover within months. Bear markets, decline 20%, take longer, historically around 19 months to bottom, but recovery eventually leads to new highs. 2007-2009 crisis. S&P 500 fell 55% but posted 70% gains the following year. 2020 crash. S&P 500 fell 30% but rebounded to new highs within months. Downturns are painful in the moment, but they rarely last forever. If you are invested in the right assets, they come back up. The most important thing is having a plan for when that big dip happens. So, you have 3 options if a big crash happens. Option 1, panic sell. You could just sell. Honestly, this is usually panic selling. Caveat, if you hold a bad or highly speculative company that is crashing, selling might be smart because it may never recover. But if we are talking about the broad market, like the S&P 500, selling is dangerous. A market drop is only a paper loss until you sell. If you hold, you haven't lost the shares, and value usually returns. The risk with selling is timing the re-entry. Most people sell low, wait for a bottom they can't predict, and end up buying back in at a higher price when the market recovers, losing money in 2 ways. Option 2, do nothing, hold. Scenario 2 is simply holding through the dip. You weather the storm. There was a famous study on the best performing investment accounts over a long period. The best investors were people who either forgot they had the account, were deceased and couldn't touch the account. Historically, markets recover. Data shows that missing just a few of the best market days, which often happen right after the worst days, can drastically reduce your long-term returns. Option 3, buy the dip. This is the favorite for building wealth, but it requires a plan. The outcome here is potentially higher returns. After big declines, average one-year returns are often significantly higher than the long-term average. How it works in practice. If the market drops 10%, you might increase your dollar cost average. If it drops 15% or 20%, you might deploy cash reserves. The risk, a dip can turn into a deeper crash. You might buy at 12% and then it drops to 20%. You have to be mentally prepared to see your portfolio drop further before it recovers. But if you have a long-term horizon, more than 3 years, the odds are historically in your favor. Who should not buy the dip? If you are retired or need the money in the next year, you shouldn't be playing the odds of buying the dip. You should focus on option 2, holding and having a safety net. A great rule of thumb is to have about 3 years of living expenses in cash. The average recession lasts 1 to 1.5 years, with bad ones lasting up to 3 years. If you have that cash buffer, you can live off it without being forced to sell your investments at the bottom. To sum up your 3 options, sell, realizes losses, and misses rebounds. Historically, a poor decision. Hold, captures the recovery, a solid strategy. Buy the dip, can boost long-term returns significantly, but requires a strong stomach and cash reserves. Market downturns are a feature, not a bug. If you've been investing for 20 years, you know this. It is going to happen, possibly this year. You need to build your plan today. Investors who had a plan last year outperformed those who just sat still. By buying heavily during the dips in March and April, many portfolios saw returns far exceeding the standard market average. Make sure you check out the next video on the channel where I go over my updated portfolio strategy and exactly how to allocate your funds based on your age. You can absolutely do this yourself. Remember to keep investing simplified. I'm Zuhair, and I'll see you in the next one.